and welcome back. In today's video, we're going to talk through how debits and credits work with accounts that are classified as liabilities. So let's get started. Hi there. Today we're going to talk about liabilities. Liabilities is another category in the chart of accounts, and we can have hundreds or thousands of accounts that are liabilities on the balance sheet. And the good news is that liabilities, you will always find them on the balance sheet. They will not ever be found on the income statement. Liabilities are defined as legal debts that are paid over time. So what business transactions can cause us to affect a liability account? Well, first is we can buy stuff that we need on credit from our vendors. When we do this, what we're doing is affecting an account called accounts payable. And we can pay over time. Maybe we have terms of 20 days or 30 days, 45 days, 60 days. It doesn't really matter, but when we purchase something and we haven't actually given them cash yet, we will record that as an accounts payable. Plus, we can finance the building of an asset through the bank. When we do that, we are getting a mortgage. It's just like when we're building a house to live in. We get a mortgage from the bank. Same way, we can also get financing at a company. When we build a building, we can get a mortgage from a bank. We can also finance the building of an asset through a bond. So we may go out and issue a bond. It's an investment that investors can invest in, and that bond can help us raise money to build an asset. And then finally, another thing that companies do is something that's called deferred revenue. And I've hinted at this before. When a company like Starbucks or Target or any of these companies that have the little gift cards or their loyalty cards, things like that, those things, whenever you are putting money on them that you can use to purchase product, that is a deferred revenue. So it's not really a sale of the card. You're actually getting the card and you're putting some value on it. The company's getting the value of your cash right up front. That's a big boon. That's why it's become so popular in companies, is because if I walk into Starbucks and I want to get one of those cards and I put $20 on it, they've already got my money. Woohoo for Starbucks. They're so happy about that. I, on the other hand, if I'm using that card for myself or I'm giving it to somebody as a gift, they haven't actually received any product yet. So from the company's perspective, from Starbucks' perspective, this is a liability. They actually owe somebody who has that card $20 worth of product. And at the point that somebody walks in with that card and they say, yay, I want my latte today, then they have to produce that latte with this prepaid money that's on the account. So let's take a look at some debit and credit behavior here. So when we have accounts payable, when we're adding to accounts payable, we're going to credit that account. So when we go out and we buy some product and we pay on terms, we're adding to our accounts payable. So we will credit that account. When we actually pay the bill, that's when we will subtract from accounts payable and we will debit that account. So as you can see, our logic rules down at the bottom, our ending balance or our normal balance should equal a credit. So at the end of a period, when we add up all these transactions that go into this account, we should have a credit amount that is the net amount in that account. So when we want to increase liabilities, we credit it, and when we want to decrease a liability, we will debit it. A bond's payable. So when we issue a bond, we're going to credit bond payable. When we repay it to those investors, we're going to debit it. All of the rules are exactly the same as our accounts payable example. Mortgage payable. Here we go. We go to the bank, we secure the mortgage, we're going to credit a mortgage payable account. As we repay it to the bank, we're going to subtract from or debit that account. As you can see, our rules are exactly the same. And finally, our deferred revenue. When we go to the Starbucks store and we load that lovely gift card, it's going to be a deferred revenue to Starbucks. They're going to credit that account. When they actually provide the goods and services to the customer, that's when they will debit that account. And as you can see, all these rules are exactly the same. Thus, to recap, liabilities. The normal balance or the ending balance on any liability account is going to be a credit. You have some examples here of accounts payable, bonds payable, mortgages, and that lovely deferred revenue that we talked about. These can be short-term and long-term obligations. Accounts payable, you will tend to pay that in just a few days, less than a month. That's the kind of time frame. When you're talking about a bonds payable or a mortgage payable, you'll be paying that over many years. All liability accounts behave in this manner as far as debits and credits, and all liabilities go to the balance sheet. So thank you for listening. We're on to another subject. Bye-bye.